Okay, I think without further ado, I see people trickling in, so I'll just get us started here. Welcome everybody to our inaugural webinar in this series we're calling Tax Talk. This episode is going to be covering transfer pricing, kind of the ins and outs, and we're going to answer any questions you all may have along the way. And with that being said, I'm going to introduce you all to our partner, our corporate tax partner based out of the LA office, Yvonne Chen, and she'll take it from there. Yvonne?
Thank you, Sean, and welcome everyone. I'm very excited to moderate this session, Mazars Tax Talk, featuring transfer pricing. I hope this is going to be an interactive and fun panel discussion, target to cover some of the basics of transfer pricing, touch some of the misconceptions, and more importantly, to share with you all the Mazars approach to transfer pricing as a group globally. I want to introduce the amazing panelists that we are having for today. We have Frederic Barat from France. He is an attorney at law and partner at Mazars Advocates in France. He also leads the international tax and transfer pricing practice for Mazars France. Before Mazars, Frederic held international tax and transfer pricing positions within several multinational enterprises. His experience in multinational enterprises allows him to assist clients on global international tax and transfer pricing projects from the design to the implementation. We then have Erin Alexandra from the US. She is our leader of the Mazars US Transfer Pricing and Economic Consulting Group. And she is also a member of the Mazars Global Transfer Pricing Steering Committee. With more than 15 years of experience as an economist, she specializes in consulting related to worldwide transfer pricing issues. We also have Van Stepper from the UK. He's actually having some internet connection issues, so hopefully he is able to join us soon. He is the leader of Mazars UK transfer pricing practice, overseeing complex multi-country projects, documentation, UK commercial litigation involving arm's length principles, and transfer pricing dispute resolutions and prevention. He is also a member of the Mazars International Transfer Pricing Steering Committee, along with Erin, providing policy and technical guidance to the Mazars International Transfer Pricing community. Last but not least, I want to give a special shout out to Sahel Sass, who is joining us from Singapore today. Now it's about actually 12 o'clock midnight his local time. So coffee on us today. Sahel is a senior manager with Mazars Singapore. He is bringing his expertise in various transfer pricing domains, such as compliance, advisory, litigation, advanced pricing agreements, base erosion, and profit shifting related services to share with us some of his thoughts on today's topic. So greetings to you all from all over the world. I think the fact that all five of us are getting together for this live panel discussion already demonstrated the importance of this discussion topic today, as well as how closely all the Mazarians are working together as a team globally. There are four general areas that we want to cover today. I know all the panelists are more than expert in the area and love to talk about transfer pricing all day long. But let's focus on the objectives for today and let the discussion be less academic, but more clear and direct for our audience. Let's try our best to take the fear away from transfer pricing when people bring up this topic. Later, if we have time left, we'll open for questions from the audience group. Okay, so let me first throw in a basic entry-level question, transfer pricing 101. What is transfer pricing really? Because when I Google the term, Wikipedia told me, it's a term in a tax and accounting world. It refers to the rules and methods for pricing transactions within or between enterprises under common control or common ownership. Erin and Ben, can one of you give us a quick overview on this, maybe explain some of the common terms here?
Yeah, indeed. Perhaps I'll sort of pick this up initially, and thank you for the introduction. It's great to be speaking to you all today. So, I mean, I think if we were to put transfer pricing succinctly, really, it's the cornerstone and basis of international tax. And I don't know about you, but I often quite like to think in sort of pictures. So we've got a slide here that sort of demonstrates sort of a typical supply chain. So, you know, let's, for example, take a US company, a French company, a UK company, and they're all working together as part of an international supply chain. And in the US, you've got lots of clever people coming up with ideas, formulas, software programs, you know, intellectual property. And let's say, you know, they make that intellectual property available to manufacture in France. And France uses that intellectual property to make some widgets. They sell those widgets to a UK distributor, and the UK distributor goes off in the market and sells those widgets to third parties. And, you know, and essentially what we've got here is a transfer pricing 101. All of the profits are being realized by the UK entity. They're realizing all the external revenues. Meanwhile, France is incurring lots of costs for manufacturing, and the US is incurring lots of costs for all those bright people that have come up with the ideas. So how do we go about rewarding France and the US for their contributions to the supply chain? And that, Erin, is basically transfer pricing, isn't it?
It is absolutely. So I think you can explain a lot about transfer pricing by covering just a few different concepts. So Ben, you covered some of these. Yvonne, you've touched on a couple of these. But we have clients come to us so often and say, you know what, I'm just really struggling. I can't understand just what is transfer pricing all about. So let's review some of these concepts. I think it's worth it. The first is that a transfer price is the price charged between related parties in an intercompany transaction. Related parties are entities that operate under direct or indirect control or ownership, that they don't have to be legally related. They just have to be acting in concert to achieve a common goal together. The second big concept is that even though transfer pricing rules may cover domestic transactions in some cases, most of the time transfer pricing is thought of as an international issue that affects companies that operate in more than one country. So we're talking about multinational enterprises or M&Es. The third concept is that when we talk about transfer pricing, the easiest type of transaction to start with is the transfer of tangible goods. You know, you can see a physical product, you can count the number of units being sold or purchased, and so it's the easiest scenario to wrap your head around. But transfer pricing regulations cover all types of transactions. They apply to the provision of services. We could be talking about management services, contract R&D, administrative services. It also applies to intergroup financing. So it applies when one entity is providing a loan to another entity, or maybe they're providing a guarantee, or they're factoring the accounts receivable. Transfer pricing regulations also apply to the use or the license of intellectual property. So this could be the use of a trademark or a trade name. It could be the use of certain know-how, like a manufacturing process. So transfer pricing really is about more than just the purchase or sale of products. I think the fourth big concept, and so I saved the best for last, maybe this should have been first on my list, is what's the arm's length standard? This term shows up in so many different countries' transfer pricing regulations. And when the regulations state that related party transactions must meet the arm's length standard, this just means that intercompany prices should be set as if the two entities engaging in the transaction were not related. So essentially the intercompany price should be the going market price. I think if you have an understanding of these four basic concepts, you're pretty well on your way to understanding transfer pricing.
So Erin, you mentioned intercompany price. So So what is intercompany price really? So what role does it play in the transfer pricing world? Because I hear that term over and over a lot. And I also hear there's, the one common misconception on this is companies sometimes would really focus on the intercompany price itself, but it seems like it is actually the profit that transfer pricing, that government is truly focused on. So would you please elaborate a little bit more on this?
Yeah, exactly. So what are we talking about? Are we talking about prices, or are we talking about profits? And really, I think this all boils down to what are tax authorities interested in. So they're interested in the amount of profit that you list on your tax return. So why are they interested in this? It's because this is what they get to tax. This is the base that tax rates are applied to. So transfer prices, the price that you set and the transaction that you have with your related party, it's important because it ultimately affects the amount of taxable profit that an M&E group members will list on their local country tax returns. Although intercompany transactions they're eliminated when consolidating the financial results of the M&E as a whole. For tax purposes, the financial results of the separate entities of the M&E group, they're not consolidated. So the intercompany transactions, they're not going to be eliminated from the individual entities' results. Because of this, transfer prices can directly affect the allocation of profit of foreign M&E across all the different countries where it operates. So by altering where their taxable income is recorded, a company may be able to alter the amount of tax that they pay to the extent that tax rates are different in the different countries where they operate. To do this, a transfer pricing policy can be set up so that a higher price would be charged to the entities operating in the high tax jurisdictions. So this would reduce their taxable profit. And a lower price would be charged to entities operating in the lower tax countries. So you're shifting profits to where less tax would be paid. This is how companies can use transfer pricing to reduce their overall tax burden for the group. This is also where companies can get themselves into trouble because most tax authorities, they have the power to adjust taxable income. They can reallocate income, deductions, credits, allowances, basis, or any other item that might affect your taxable income. And they're going to reflect this so that the prices that were set, that they reflect the market price, and they're not just, the company's not just shifting profits arbitrarily to reduce taxable income.
Thank you, Erin. I think that is super helpful. So maybe Ben or Erin, either of you can share with us what are some of the common methodology for transfer pricing? Because I think that's very important to know some of the common methods.
Yeah. I'll let sort of Erin kick off on this. I mean, the one observation I would make is that the US regulations have their own particular ways of defining these methods. So, just like our sort of classic tomato, it's essentially the same thing, but we call these things sort of slightly different methods either side of the pond. But Erin, do you want to sort of walk through this from a US perspective?
Yeah, sure. So I put in my notes that we have 5 different methods that we can choose from, but it's really 6. The number 6 is an unspecified method, so we'll stick to what I have in my notes and we'll just call it 5. So we have 5 different methods that we can use to analyze transfer pricing activity, and they fall into 2 categories. One category would be the transactional methods, and these methods look at individual transactions or prices. And then the other group would be the profit-based methods, and these will look at an entity's overall profits. Each method takes a slightly different approach and has the associated benefits and risks. And there are also rules as to which method would be best suited to your particular set of facts and circumstances. And although most transfer pricing regulations specify that organizations have to select the method that's best or most appropriate. In the U.S., at least, one method is used probably, at least bare minimum 90% of the time. And this is the comparable profits method. It's the CPM. And this method analyzes an entity's overall profits by testing its profits against the profits of comparable companies. And we'll do this with certain ratios like the operating margin ratio or maybe like the markup on total cost.
So I saw we have actually an example diagram in the slide. Maybe Ben, you can give us maybe an example on this. I think that can help the audience to better understand the concept.
Yeah, indeed. So if we go back to sort of effectively, this is sort of my original visual really. The CPM and the comparable profits method in OECD world outside of the US is called a transactional net margin method, or a TNMM. I much prefer the CPM. It's a lot easier to say, I have to say. But anyway, let's just talk about this as an example then, and let's take the UK as the starting point. So the UK, in the example I gave, was basically had all the cash, had all the profits initially. So one way of remunerating the UK would be to look at the comparable profits method, and let's say you do a study, it should have a return on revenues of 3%. If we plug that into the UK financials, that basically means the UK needs to pay 70 million to France for the goods that it's acquired from the manufacturing process. So that then comes across and becomes France's turnover. Now, there could be two ways of looking at France's profits. It's used the US IP. So you could use a comparable uncontrolled transaction, a cut from a US perspective, or a cup from a UK perspective, a comparable uncontrolled price method, and you might be able to find a royalty rate of say 4% for that type of activity. The other way you could look at this is say, well, perhaps France is a routine manufacturer, maybe a return on total costs is appropriate. And let's say that return on total costs is 2.5%. Either way, that residual profit, is going over to the US. I would say this is quite a fanciful example. It's very rare that you find the economics working quite as neatly as this. We usually have quite a tough job in working through the economic analysis, but hopefully that gives you a bit of a feel of how all the transfer pricing methods can interplay to reward each of the entities in the supply chain.
Thank you, Ben. That's very helpful. So without getting into the weeds, there are obviously different methods applied for different situations. But from companies' perspective, I think they really care or want to know when would transfer pricing kicks in and becomes relevant to them, right? So another common misconception I hear a lot is companies often think that they're too small and they're not considered as multinational enterprises. Therefore, they don't really need to worry about transfer pricing, or companies that they're having losses for years, and they really think, transfer pricing is not going to be relevant to them. So Sahel or Frederick, would maybe one of you please give us some guidance on this from high level perspective, when companies need to watch out for transfer pricing?
Propose Sahil that you start.
Yeah. Greetings, everyone. So, while we were just discussing, what exactly is transfer pricing, so the basic premise as of now, while we are discussing with all of you, is that globally, in any part of the world and any region, the most of the tax authorities are now emphasizing on this fact that if there are related party transactions between any, taking for example, if there are two entities within a group and they are having any kind of transactions which Erin was mentioning, like services, or it could be sale of goods or manufacturing of goods, etc. So if there are any kind of related party transactions between the entities of a same group, in that perspective, the transfer pricing provisions would apply. And the main reason for that is that the tax authorities in every local jurisdiction requires that the price at which the transaction is happening, it is at the arm's length, or if we put it in a more simpler way, it is reflective of the market price, or it is the appropriate price. So that is what the main requirement from all the authorities is, that the transfer pricing will apply to most of the M&E groups, whether whatever, depending upon the size of the group, whether it could be a small or a mid-size or an enterprise or even a startup kind of a group. And it would also apply to transactions between related entities which are having different tax treatments operating in the same jurisdiction. So for such kind of transaction, whether it's cross-border or even domestic, the transfer pricing provisions will apply for both the set of transactions. So yeah, Frederick, you want to add on this?
Yeah, generally losses is making losses, let's say outside of the US, is a red flag for tax authorities, and that's a way to attract tax authorities to launch tax audits, including TP. That is why when you have losses, there is a real need to analyze the situation and make sure you are not having an exposure, a TP exposure. Moreover, the rules per country in terms of TP documentation vary a lot, and there may be some threshold for preparing a TP documentation, but in many countries the thresholds may be very low, and there are also some countries that have no threshold, which means that each intra-group transaction need to be documented. Otherwise, multinationals run the risk to have penalties and interest for late payment in case of tax audit.
Yeah, absolutely.
Thank you, Sahel. Thank you, Frederick. So, Frederick, you mentioned, TP document, transfer pricing documentation. So, from my understanding, transfer pricing can become very hairy. The more you go into it, the more complicated it can become, because it has overlaps with other tax codes that companies need to be aware, as well as the various transfer pricing compliance requirement in different countries. Would you please maybe elaborate just a little bit on this part?
Sure, and in fact, you're completely true. TP is just one aspect that need to be analyzed along with other taxes. For example, TP need to be analyzed with customs tax, with indirect tax like VAT, or in Europe, or GST in Singapore, for example. It also need to be, it has also some impact on tax deductibility of certain costs, for example, interest, for example, payment of royalties. And also it has some US implications, but I won't develop too much around the BET and the GILTI. So each tax code define the TP documentation requirements, as I mentioned. So TP should not be reviewed in isolation.
So, Hel, do you have anything to add on the TP documentation?
So, and just to add on the transfer pricing documentation part. So, I like, as Frederick was mentioning, every country will have different requirements for the preparation and the maintenance. And in some countries, there is a compulsory requirement to file the transfer pricing documentation with the tax authorities. So in some countries, it's primarily the preparation and the maintenance part, and in some countries, it's the submission with your regular corporate tax return. So then it becomes more important and imperative that depending upon the country in which your operations are, you need to carefully analyze the transfer pricing documentation requirements, because one point I just wanted to highlight here is that sometimes when we discuss with the clients, they think that maybe it's just a one-off exercise and then we are done, but it's a annual compliance assessment requirement, so it happens every year. So this is something which, and again, the main base is that if you have transaction between your related parties, we need to ensure that they are at arm's length.
Thank you, Sahel. Wow, there seems to be a lot to watch out in the transfer pricing world. So if companies view this from a risk management perspective, so what are some of the activities or situations that would increase transfer pricing risk?
I may start on that. Basically, the biggest exposure is the situation whereby there is no consistency within a multinational in terms of TP policy, which means that there are different rules, different processes applied around the globe, which are not consistent at all, and then give rise to a challenge by the tax authorities. Moreover, the more a group has intra-group transactions, or the bigger they are, the bigger the risk is. TP risk is also increased when a group has transactions with tax haven, because that's another red flag for tax authorities. And TP risk may also be increased where HQ is profitable and some or all the subsidiaries abroad are in a loss situation. As I mentioned, loss is usually a red flag for tax authorities, because it just shows that something is unbalanced, especially if the losses are recurrent. Maybe you may want to add on, Sahil, on
So yes, so again, depending upon some of the important areas or the situations which can increase transfer pricing risk or the potential tax queries. So in case of certain kind of, I would say, primarily transactions, obviously it will depend upon how many transactions one has and how many what are the volumes involved. But some of the hot favorites which we have experienced from our litigation experience is that, first of all, any kind of transactions involving intangibles. It could be royalty fee or a license fee or a franchise fee or a trademark fee. These are some certain classification of transactions which might lead to an increased transfer pricing risk. And second of all, if a company which is operating on a fixed cost plus markup kind of scenario, wherein it is just providing services to its related party and it is operating on a cost plus markup, if it is having sustainable losses over a considerable period of time, such a situation would also lead to a slight increase in the transfer pricing risk. And apart from these two, the other kind of transactions can involve management services or financial transactions like loans. So, but these are some of the immediate red flags which we can see in any kind of transfer pricing setup. And this will require more and a detailed attention to the transfer pricing policy of the group. Yeah.
Thank you, Sahel, and thank you, Frederick. So based on what both of you have shared, it seems like transfer pricing risk can be very high before companies even start to realize it. Then if I stand in the company shoes, I would think, oh, transfer pricing must be a very expensive and time-consuming practice based on all the things that we just discussed, especially in the beginning, when companies start to engage professional firms for transfer pricing studies or work, they really need to spend a fortune to get the transfer pricing documentation, I call it dictionary, completed. So Ben, Frederick, maybe either one of you can give us some light on the different deliverables of transfer pricing and share Mazars' approach to transfer pricing.
maybe Ben, you can start.
Yeah, so I think if we just flick the slide, I mean, I think the first thing I would say is clearly doing something in transfer pricing is better than doing nothing. Tax authorities do take a risk-based approach. So, your approach to transfer pricing can be proportionate to the size of your group. For very, very large groups, there are sort of certain mandatory forms in which you have to document your transfer pricing policies and prove that your transactions are indeed arm's length. So these are the so-called sort of master file, local file approaches, which have a very formulaic approach in the way you should be setting out the functional analysis of your group and certain facts, as well as reconciliations to your financial statements and why they're arm's length. But that's for the very largest groups. For smaller groups, something called a planning report, may be a good starting point. We call those, again, slightly different elsewhere. So we might call them a diagnostic. So this is a risk-based review of your group. We'll have a look at the intercompany arrangements and the transactions and say, well, these are the transfer pricing policies we think that are appropriate. And these are the ranges of pricing that might apply in that particular case, and that can form a sort of a first tier sort of policy statement that puts you on the right track. We can do a risk analysis as well, so you may already have a transfer pricing policy in place, and you'd just like that sense checked. And again, you know, that's probably a lighter touch still from the planning report. Again, we can have a look at it, discuss your business, and do some sort of a red flags really on things that you might want to look at with priorities sort of attached to that. And then, you know, the final one really, which can be often the most cost effective, is this sort of economic analysis. So if you recall the slide that I had a little while ago, where we're looking at you know, the comparable profits method, looking at those sort of target operating margins. So, you know, for example, in the IP electronic software sort of business, you might have all your IP in the UK, and it might be quite a short in the US, and you might have quite a short supply chain. So you might have then lots of distributors around the world, in which case, you know, looking at the operating margins of your distributors probably isn't a terrible place to start.
I think, if I just want to conclude on this topic, the diagnostic is a key step for new practitioners in transfer pricing, because this really allows multinationals to assess their risk, assess their compliance in terms of TP documentation, in terms of legal documentation, and define a roadmap toward a more compliant TP organization. And that's really a key steps, and that's probably the first step to follow in order to really assess the level of compliance of your group.
Thank you, Frederick, and thank you, Ben. One more thing I actually want to ask, you know, on behalf of the audience group is, there is obviously a legal aspect to transfer pricing world as well, right? So Frederick, maybe you can share with us, you know, the interaction on the legal side, right? And also the importance of legal documentation.
Yes, Ben mentioned a chart where there was a royalty payment made to the US. In this case, there is a need to have a royalty agreement. Ben mentioned the fact that France was manufacturing goods for the UK. Then in this case, you need a contract manufacturing agreement. Basically, for all intra-group transactions, there is a need to have a legal documentation that describe properly the transactions. It is very important that the legal documentation is fully aligned to the transactions and to the TP documentation. And Ben mentioned that companies need to prepare local files, and generally the legal documentation is appendix to the local files of each individual entities, because basically this is the complement to the description of the intra-group transactions that exist within the legal documentation. So legal documentation is equally important to, I would say, TP documentation. I don't know, Ben, if you want to add on.
Yeah, I think that's right, Frederick. You know, it's the starting point that many tax authorities will ask for when they want to understand the arrangements and the interactions between the companies. I mean, the one thing I would say is that a legal agreement on its own in the transfer pricing world isn't definitive. You know, it's very important that functionally what's described in the agreement is what's happening in the real world, and you know, the respective risks and functions and contributions of the parties are fairly represented in the legal documentation. If you've got an alignment of functional reality and legal documents, you know, that becomes then quite a strong defense, and it's quite difficult then for tax authorities to, what we might say, recharacterize a transaction or try and reprice it in some way. So legal agreements aligned with functional realities is a very strong position to be in.
Same important. swimming for them. We understand. Thank you both. I think this is super helpful to really help us to put all the pieces together, for transfer pricing. Then I think last part, I think most companies would ask, besides just being compliant with the transfer pricing requirements and, avoid being chased by tax authorities, is there any real economic value beyond just transfer pricing compliance?
I think Erin, you can take first and
Yeah, I'll start. So this is definitely a topic close to my heart. Transfer pricing can be more than just a compliance exercise. Well, I mean, not just that it can be, but it should be, right? At the end of so many engagements that we've completed with our clients, we hear things like, wow, we didn't know that some of our manufacturing facilities were more efficient than others because our prior transfer pricing policy was covering that up. Or, as the parent company, we're providing services, we've been providing services to our subsidiaries, and we didn't know that they were performing these activities for themselves already, and we're duplicating, this work. So really, you should be thinking about transfer pricing more as it relates to your whole business, not just as it relates to maybe what kind of report am I going to get at the end of this project. And so transfer pricing can be used to review how a group is currently operating, kind of like the examples I gave, but it can also be used as a planning tool to look forward. For example, it's really helpful when there's a big industry change. You can use transfer pricing to help, maybe pick different entities or different subsidiaries within your group that you need to swap in or out when you have to make a supply chain change. Or it can be used in anticipation of certain events, events beyond just a tax audit. It could be when there's going to be a sale or some kind of ownership change. A lot of times a company will be questioned about its transfer pricing activities because a purchaser doesn't want to take on a potential future tax liability. A lot of times we hear clients come to us and they say, well, our bank has asked for our transfer pricing documentation, or another lender or investor has asked about our transfer pricing policy, for the same reasons. So there are lots of situations where you might need to produce a transfer pricing analysis, or where it might be helpful for you, beyond just tax compliance reasons. Do you agree,
Yeah.
Sid?
Yeah, and I think to add on one one specific point here, that apart from in today's the global world and the kind of developments which we are witnessing, one of the most important which hit almost every kind of company was the pandemic, right? And which is still slightly ongoing. It's quietly now stable, but it's still ongoing. So as a result of these kind of this kind of uncontrollable factor, we saw many disruptions in the overall value chain of the group. So what I mean is that there have been many instances like companies operating in one particular Asian country as maybe a manufacturer. Due to all the disruptions to the materials, to the movement of people, the manufacturing base shifted from one country to another country. So in such kind of situation, the transfer pricing documentation would not help. We need to have a more analysis which will help to add the value, and which is now generally being called as the value chain alignment. So and this is also prescribed by the global body, which I'm sure most of you would have heard about it, which is known as the OECD, the Organization for Economic Cooperation and Development. So they are also prescribing that now transfer pricing documentation is maybe just a first stepping stone. Now we have to move on to more important, relevant compliance requirements like the value chain alignment or any other kind of group policy, which not only will ensure the transfer pricing compliance, but it will bring overall cost efficiencies, operational efficiencies, and consistency of policies across the group. So right now the focus is on this. So these are some of the, I would say, more tangible and at the same time intangible values which add due to the transfer pricing analysis.
Thank you, Sahel, and thank you, Aaron, and as well as the Frederick and Ben, all the panelists today. I think we can all keep going and talk about transfer pricing all day. But thank you very much for sharing with us all the good stuff today. I hope we did not bore all the audience today with transfer pricing. I think we have a few minutes left here, maybe for one question from the audience group. Let me see what we got here. Okay, so we have a question here. We have agents outside of the US, which originate the sales made by the US headquarters. Does this structure create a transfer pricing exposure for us?
Maybe I can take this one. Potentially, if the agent basically is not rewarded at arm's length, that could be the first issue. There is potentially another issue if the clients are invoiced by the US company, and basically there's no invoicing in the country of the agent that originated the client, because the tax authorities may consider that the US company has a permanent establishment in that foreign country through the agent, and there is a risk of double taxation. That's all.
And I think maybe just to one small point which I just want to add on what Frederick has mentioned. So yes, the transfer pricing provisions might apply for such kind of arrangement, and there could be the exposure what Frederick was mentioning of an agency permanent establishment. So if there is that kind of exposure, then also now the global body of OECD, they have also prescribed one approach which is known as the AOA approach, the authorized OECD approach, which is related to the allocation of profits in case an agency PE or any other kind of PE has been established. So these are also some of the additional requirements which you might have to analyze for such a kind of arrangement also.
Thank you both. I saw one more question from earlier time. The audience said, our company transfer customer contracts to our distribution center subsidiaries outside of the US. Is there a TP transfer pricing issue here?
I would start to answer potentially, because basically this means that an intangible has been transferred outside of the US. And if it is not, if the transfer is not rewarded at arm's length, meaning that the foreign subsidiaries did not compensate the US headquarters, there will be a transfer pricing exposure in the US that will have transferred a valuable intangible. I don't know if somebody else wants to complement.
Yeah, I mean, I can perhaps sort of add another little perspective of this, and it's always one of my challenges to mention Brexit in every possible webinar I do. So in Brexit planning, we did have this sort of situation really where customer relationships, invoicing was moving cross-border. But going back to what I was saying before around sort of legal form and functional form, if you're finding that actually those customers' relationships are still being maintained in the US, and maybe sort of it's just the invoicing that's done elsewhere, then actually we can use transfer pricing in the company's favor, and perhaps substantiate that whilst legally some intangibles have moved, actually the profits should still flow back to the US, because they're still managing those relationships. So if the profits haven't shifted, they're staying where they are, the impact of the moving of the contractual form might be a lot less. So in those circumstances, we can perhaps use transfer pricing in our favor.
Thank you, Ben, and thank you everyone again. I think with the limited time that we have today, that's probably going to be all that we will be able to cover today. I also want to mention the next topic for our upcoming Mazars Tax Talk will be around global mobility on October 20th. I will continue to be the moderator for the next session. and we'll invite subject matter experts in the area for a similar live panel discussion. We also have a few more transfer pricing webinars coming up and hosted by Mazars globally. If you are interested in any of the upcoming topics, please feel free to reach out to us after this webinar. We're happy to send the invite for those sections. Thank you everyone for joining us today. Have a wonderful day.